our opinion that there's been an awful lot of linear thinking, right? So if you think about tax reform, if you think about aggressive rollback of regulation and healthcare, there has been an awful lot, $3 trillion, give or take, that have been added to the stock market in the hopes, and I emphasize hope, that this is going to be legislated in and potentially even retroactive. The reality is it's going to be nothing close to that, right? We are believers that the fixed income market sets the prices for equities, especially for long duration growth assets, right? And so we are still trying to figure out, is the 10-year fairly valued at 160, 235, 4? It's unclear, right? So we would, as equity investors, we'd like the Fed to be out of the picture so we do have price discovery and we can fairly value equities. We are a high-quality growth manager with long-duration growth assets. The rise in rates has clearly impacted some of our longer tail, right, growth instruments, as we discussed, right? As you do your DCFs, higher rates obviously impact future cash flow. That said, the parts of the portfolio that we are frankly underweight in, right, the deepest part of the cycle, have done exceedingly well. Some of these groups have doubled and then almost doubled again. Parts of the energy patch, trucking, aggregates, those that are tied to infrastructure, corporate tax reform, right, that benefits U.S. domiciled companies have done exceedingly well, and these are, generally speaking, areas that we are underweight in. The other area that has impacted us negatively is we have a fairly sizable healthcare set of positions, and although it's diversified, these can be almost construed as counter-cyclical, and so they haven't benefited to the extent that many other groups have, whether it's in technology or media, or, as I mentioned, the deepest part of the cycle. That's actually the area that we find most fascinating right now. We've spent a lot of time in this space. We don't think we have our head in the sand. We understand that healthcare is under the microscope and is potentially in front of a damaging tweet here or there. But that said, that's actually been an area that we've been adding to, given the level of the outperformance. There's a couple opportunities that we continue to develop. We've got exposure to a lot of them, but this battle between content and distribution in large media. It's you hear about OTT, over the top, cord cutting, and so forth. Who is going to be the eventual beneficiary? Can people price their products, right? The ESPNs of the world and so forth, relative to the distributors. Biopharma is another area that we've done extensive work. We've got large exposure there. Another area is with the driver assistance and automation in the vehicle. This is something where there's an awful lot of hype, and we're trying to distill that opportunity within sensors and inverters and all sorts of componentry. Who is going to win, who is going to lose, and that could potentially be an enormous opportunity for us. And then lastly is just technology in general, right? The movement to the cloud it's permanent, and more than guessing who the winners are, you just want to make sure that you understand who the losers are, and make sure you don't have any exposure right there. So that's a tectonic shift that I would argue is still in its infancy.